This is the monetary policy statement for May 2012. Inflationary pressures continued to ease in April 2012, declining for the sixth consecutive month. Annual headline and core inflation declined to 20.3% and 22.8% respectively in April 2012, from the peaks of 30.5% and 30.8% respectively in October 2011. Annual food inflation also declined 15.1% in April 2012 from a peak of 50.4% in September 2011. The decline in inflation over the last 6 months vindicates Bank of Uganda's monetary policy stance aimed at curbing inflationary pressures. Furthermore, the sharp decline in monetary and credit aggregates, which began in Q4 2011, has now flattened out. The main risk to continued falls in inflation is the upward surge in food prices since February 2012. Furthermore, food prices could rise further between May and July 2012. Month-on-month, food crop inflation averaged 7.2% in the last 3 months, compared to minus 2.9% in the 3 months to January 2012. And this has spilled over into core inflation. Non-food inflation has also remained sticky at about 23% since October 2011, although aggregate demand has remained subdued. The global economic outlook is somewhat brighter than in the previous months, though downward risks and long-term challenges remain. Though oil prices eased in April, concerns of supply shocks which cause oil prices to surge higher remain elevated. Therefore, developments in oil prices remain a big factor in Bank of Uganda's efforts to curb inflationary pressures downwards. Furthermore, although the exchange rate has been relatively stable in April, the weak current account of the balance of payments, in part reflecting a combination of weak external demand, declining international coffee prices, and the associated exchange rate depreciation pressures, are a source of a major upside risk to inflation. The Bank of Uganda recognizes that real economic growth is currently below potential. help stimulate growth, Bank of Uganda expects to reduce the central bank rate later in 2012 once the risks to the inflation outlook have receded. However, in the light of the current risks to the inflation outlook, particularly from high food prices, Bank of Uganda has decided to maintain a neutral monetary policy stance and therefore hold the central bank rate at 21% in May 2012. That means holding the rate where it has been. The band on the central bank rate will remain at plus or minus 3 percentage points, and the margin on the rediscount rate will remain at 4 percentage points on the CBR. Therefore, the rediscount rate and the bank rate will remain at 25% and 26% respectively. The Bank of Uganda remains firmly committed to bringing down inflation and stabilizing it around its medium-term target of 5%. The revised inflation forecasts for December 2012 and June 2013 indicate inflation in the ranges of 8 to 12% and of 5 to 7% respectively. I am therefore confident that the Bank of Uganda will achieve its medium-term target of inflation of 5%.